this is probably an obvious question or something that is obvious to all of you, but not to me and not to a lot of our readers, which is why I wanted to start out by asking, what is fintech? But before we do that, we're going to have everybody go around and introduce themselves. And so the court reporter is perfectly clear and the video is clear. So, and maybe tell us a little bit about yourself and how long you've been with your company. We'll start with Mike.
Well, good morning, and thank you for allowing us to be with you today. My name is Mike Kurish. I'm the CEO of the Associated School Employees Credit Union. I've been with the credit union since 1985. The Associated School Employees Credit Union was originally formed to serve the employees of the Austintown School District, and we've been in existence since about 1959, as I said. So that makes us one of the longest financial institutions in the area, or the financial institution in the area that has the longest roots anyhow. So we're very proud of that fact. We're proud to serve the community, and we're happy to see the growth that's come along over these 40s.
Now be sure to everybody to project, speak up so the court reporter can hear you. Everything will be videotaped as well, but project, please.
Hi, I'm Christine Blake, CEO of Cardinal Credit Union. I have been CEO since 2010. Our credit union started as a teachers credit union in Mentor, Ohio, and over the years we've grown. We have a national charter now, so now we serve anyone in the United States, and it is a pleasure to be here.
Good morning, I'm Matt Bellin. I am Senior Vice President, Commercial Relationship Manager with Middlefield Bank. Middlefield is a community bank. We have 3 markets in Ohio that we serve. We have a Northeast, a Central, and a Western Ohio market. I've been with Middlefield for about 18 years now. It's been a pleasure working for a community bank in my hometown as well that I'd like to participate in. Other than that, I'm excited about this roundtable and sharing some ideas.
Thank you.
Good morning, John Demmler, CEO at 717 Credit Union. I've been with the credit union for just over 1 year. 717 has been a locally owned credit union for the past 67 years, serving the Mahoning Valley, and we are excited to be here today as well.
Good morning. I'm Sandy Carangi, and I'm the CEO of Mercer County Community Federal Credit Union. And I have been working with credit unions for about 26 years. Locally, I've been with Mercer County Credit Union for 10 years as the CEO. And we serve 7 counties. We serve 4 counties in Pennsylvania, and we serve 3 counties in Ohio.
Thank you.
Good morning, everybody. Josh Toot, Market President, Premier Bank. I've been working in the Valley in banking for 23 years, only at 2 banks. I've been at Home Savings Premier now for 7 years. Love it, love the small bank feel, love the Valley, live in Canfield, and excited to be here today.
And good morning, I'm Mark Wenick. I'm Senior Executive Vice President and Chief Wealth Management Officer at Farmers National Bank. We're the young institution in the group. We were formed in 1887. And I'm pleased to tell you that Kevin Helmick, our CEO, is only the 9th CEO at Farmers. And the reason I tell you that, we're going to be opening our new headquarters in Canfield, the expansion of our headquarters, and we're very proud to put a heritage wall which will feature the CEOs of Farmers National Bank. We should be moving in February of 25.
Wow, we'll be sure to cover that.
Very excited, yep. Thank you.
Well, thank you all. And now we're going to begin with the first question. What is fintech and how is it disrupting local banking? Are online banks cutting into the market shares of local banks and credit unions? We'll start with Mark. We'll go this way. Everybody can give a response. And then the next few questions, we'll open it up to everybody. So Mark,
yeah, thank you.
Explain it.
Yeah, well, I'll do my best. Fintech, it's financial technology, and it's really driven by outstanding technology, which is really kind of blossomed into a payment system, if you will. We see it affecting our local bank in terms of people that are rate shopping. A lot of individuals look for opportunities to get a little better rate on their deposits, and they reach out to fintech type companies for that advantage. Obviously there's a place for fintech. We would be exploring it, usually utilizing vendors. It's very important for international people that do international business, foreign exchange. They've just done a wonderful job in terms of the technological aspects of it. Has it really hurt our business? Like I said, a lot of our customers that have used fintech for deposits, we find the deposits coming back to the valley in a lot of cases. So that would be, again, the way we look at fintech.
Yeah, in addition to what Mark said, when fintech first was announced, I think a lot of banks panicked that we would lose market share. And I think on the consumer side with mortgages and online checking accounts, I think you started to. Not so much on the commercial side at all. I don't think they really have a product for that relationship. But now fintech is almost like a partner with banks. They fill the gaps for efficiencies where maybe opening accounts quicker, anything to do with mobile banking. They come out with the technology, the banks acquire it via third party. And to be honest, I think fintech is now making banks much more user-friendly with that younger generation, the people that are capable of the online banking and are wanting the online banking and the mobile banking. So fintech is now more of an ally, I think, than it is taking market share away from us.
Sandy, how's it impact credit unions?
So same thing here, as both gentlemen just said, is that we feel that fintech, financial technology, has really, we now partner with a lot of the vendors, and it actually is helping us to move forward. I believe that we actually have benefited by being able to offer a lot more technology. It almost pushed us into offering things that members wanted and that the public wanted us to offer through financial services. So in recent years, I believe that technology has kind of exploded in the financial services industry. Credit unions have embraced it, and people, it's amazing how much people depend on mobile banking and doing everything online. But I think what sets us apart, as far as I agree there, that I don't really feel like we're competing with that. I think at the beginning everybody thought, oh yeah, all these fintech companies, everybody's going to go to them. But I think we all have something unique here in that we have that personal relationship that people so want, and that makes us that we're offering these financial the services both online, but also that personal service. We can do that too, so we can do both, which actually helps us.
John?
Yeah, I think fintechs have really just accelerated a transformation in service delivery for financial institutions. When we look at the transition of banking from kind of like checking accounts as writing a check as a payment delivery mechanism to now a digital transfer of money and digital payments, and everything from the Apple Wallet and Venmo and all of these online checking accounts. The service expectations now of consumers have been elevated to where fintechs have become integrated into banking and just provide better service. So I agree that what may have started out as a disruption for the industry was really more of an awakening of the industry, that we have to provide the right digital solutions and the right service and value delivery to our members. I think that's what fintechs have done. It's really elevated the game for financial institutions, and they've since become just a great partner.
Please.
Yeah, I agree with everything said so far. It's kind of a double-edged sword, in my opinion. On one respect, it has allowed banks and credit unions to operate, frankly, more efficiently, deliver better service to clients at a lower cost, and frankly, meeting the expectation of today's consumer. Definitely on the consumer side, I think it's been more of a disruptor. I think, as Josh mentioned, people are shopping rates then for both deposits as well as loans, so it gives more options for consumers. Then on the other side of that sword, then too, it's new competitors that have entered the market that can operate even more efficiently than us. We have brick and mortar we have to pay for. The fintechs that we're competing with can operate even more efficiently because they don't have the overhead that community banks and credit unions have to deal with. So definitely good and bad as far as the financial technology has impacted us, at least.
I think I'd like to highlight two things that people have said already. One is it's the integration of technology And we look at fintechs as a way to partner that enable us to bring services and experiences to our members that we would not be able to otherwise. And just three short examples. So one, in the lending, for fintech lending, our fintech partner in the lending arena now allows us to be completely online. So now a member, if they want a loan, they do not even have to come into the brick and mortar branch. If they do not choose to, they can open it online. So it gives more options that we didn't have previously, along with the security and compliance that we need to have. So that's one in the lending arena. The second is in the investment arena. We have a new fintech that we're partnering with. It's called Bits of Stock. And one of its new products is it basically allows you to have reward points on your debit card, and then you can use those reward points to buy stocks. And we're going to use this to roll out to our student branches. So we teach in 8 high schools, and that way the students are learning lending and investment without putting their own money at risk. And we feel that that's a really neat product with a fintech that brings an experience to the youth that they may not have otherwise. And that's just a good example of a fintech. So much so that we're also going to invest in the fintech. So when you look at how they're disruptive, it's also disruptive, but it also allows us the opportunity to invest in fintechs as well. And then the last one is just education. There's many products on the market that help teach financial education, whether it's credit score or how to improve your finances. So with our new digital platform, one of the fintech partners we were able to easily integrate was called Savvy Money. And so now it is very similar to some things that you've seen anywhere, but it can give you your credit report on the spot, give you tips for improvement on the spot. So if you want to do it just online, you can, or if you want to come in and meet with one of our financial counselors, they're available as well. So it gives more options than we had previously. So that's how we're looking at fintechs. How do we partner with them to enhance the experience that we're bringing to our members?
Well, Mike?
Well, you get to this point, a lot's been said on, and I agree with everything that has been said. But if you look at it in its purest form, you said it's financial and technology. And financial institutions have been exposed to technology changes for many years. You back into the 70s, you'll find that there were ATM cards that were made available to individuals that changed the way that individuals conducted their financial activities. We have seen a transition where employers have utilized ACH to make deposits into financial institutions, which have changed the behavior of consumers, where they no longer have to go to the financial institution on a Friday to make their deposits. That's improved their lifestyles, and they've given time back to the consumers. The fintech that we talk about today, the digital platforms, is doing the same thing. It's causing the financial institutions to evolve. It's causing us to have to innovate. And the consumer is the winner out of these equations. They have the opportunity to have more choices. Our competitors are no longer the brick and mortar institutions down the street. Consumers have the opportunity to have their financial products delivered to them by individuals or firms that live across the country, maybe even out of the country. And it gives them 24 access to their finances, to be able to move money between relationships that they have. It gives them more control. It allows them to customize their finances to their own suiting. So I think us as financial institutions have to find a way to employ this in our operations to continue to be relevant to the individuals that we serve.
So I guess the question is, what's next? And I know that a big part of fintech is cybersecurity, and that's another issue. But what is next? I mean, how are we going to bank in the future? What's your crystal ball show? And as we get to being more digital banking and more, what about the branches? Are we going to have as many branches? Now, I know some of the bigger banks are closing branches. Here, we're seeing a little bit of it, but what about the branches? Anybody? Go for it.
Go ahead.
Yeah, I think branches really serve an important part of serving the communities. And, I think, the fintechs will, and in the digital transformation of banking, we will all be banking on our phones more. I think even banking, online on the computer is almost antiquated. The ability to check your balance by opening up your phone, transfer money, make payments. All of that is so convenient. And I think that will be something that will be a dominant form of banking. But the branches serve, I think, a different purpose. And, 717 is actually, we have 13 branches in the market. We're looking to nearly double the number of branches that we have in the market over the next 6 years. So we're making a significant investment into our branch network because we view branches not as transaction centers, but as kind of launching pads into the community to serve our community. One of the things that I think people will use branches for more is for consultative conversations. We look to expand our wealth management, insurance brokerages. I think it's, when you're looking to make major decisions, sometimes it's helpful to come in and talk to someone when you're looking to buy a home, save for retirement. Those are big decisions, and I think branches will serve a good use for that in the future.
Mark?
Yeah, I'll be happy to. Mike mentioned ATM cards earlier. In 1981, that was supposed to be the demise of branches. I mean, so you think about branches are always on life support, and I would challenge you. If you look at some of the largest banks in the country, they're starting to expand. I read the other day we had one that was talking about adding 500 branches, another one 200 branches. Now, in their branch networks, that may not be a big number, but at the end of the day, for us, I would agree with John. I mean, it is more than just a transaction. Now, demographically, it's important to understand that we have a demographic here in the Valley, primarily, and in most of our markets at Farmers, where we still have customers that love to come into the branch. It's more of a social event, if you will. But now for the younger generation, where mobile banking seems to be the most popular entree into our bank, there's still opportunity to come in and sit down and have either sit down and talk about some planning or even a discussion around retirement, whatever the case may be, so that we can offer the full menu of services that we have at Farmers. So again, it's not your father's or grandfather's branch anymore. It can't be, or you won't survive. Now, branch optimization is very important, though. I mean, as we're, entrusted with our shareholders and our customers, and you have to look at the opportunity to, if you decide you want to shutter a branch for whatever reason, proximity to another one, or maybe it's just not doing as well as you expected, but then you've got to backfill and then go de novo and put a branch in a spot where you think it makes sense. So for us, very, very important strategy at Farmers as well.
The thing about technology, I think we can all accept that it moves quickly. And if you're not 5 years, 10 years ahead of it, you're going to probably get passed up. But the other side of technology is you remove a little bit of the service and the customer service aspect that banks and credit unions are used to. So I think the branches will always be extremely important, like Mark said, because everything's easy online until you have a problem. And now you're on a 1-800 number and you can't get a hold of somebody and it has something to do with your mortgage and they're not accepting your payment. You want to sit and talk to someone that you have a familiar face, that you can go back to. So I think there's always going to be an aspect of customer service with fintech. And we really dilute that by saying like, oh, it's going to be the end of branches. Like Mark said, I think I've heard that 3 times in my 23-year career that branches are going to shrink. And every year, everybody goes through your branch, sees what your transaction count is, see if it's what your community needs. And sometimes it is pulling 2 branches close together and maybe having a better location and a better branch and experience for your clients. But I don't see the world of branches going away anytime soon.
Anybody over here, please?
I just want to say that I think that there's always going to be a need for brick and mortar. I think individuals like the stability that represents to them as compared to what they see in some fintechs. A lot of the fintech activity that you see today with some of the online banking are individual secondary accounts. It's where they go to as not their primary financial institution. I do, however, think that branches are going to change. They're going to evolve. I'm sure each of us are familiar with walking into some old banks and seeing a line of teller windows. You may see some older facilities that would have 10 of them, and you go to them today and only 2 of them are utilized. The other 8 of them have storage or have some other secondary purpose. So I do think that it's very possible that branches are going to become smaller, more efficient. They're going to take on a different footprint as there's less and less person-to-person activity that occurs in financial transactions.
Anyone else?
I think I agree with everything that's been said, but I also think that branches support the technology. So you have all this technology that people use, and then they rely on having a place that they can go to for like financial counseling or education. So in a way, it's that the branches are supporting that technology. The difference is that technology has exploded when you look at the transaction volume. The branches still are growing as far as transaction, but it's very slow. So people move away from that and use technology more. And then technology, it's been amazing how many people actually use the technology. So that has grown a lot more, but it's the branches that actually support that. So I agree with, what somebody said here with when you have a problem, you want to be able to talk to somebody, you want to be able to go and see it. The other thing is the trust. The branches and having a physical presence gives a sense of trust that you can go somewhere and you can talk to somebody. When you're working with a financial institution that's only online, there is no person that you see. There isn't that trust that you form with that. Another thing that's really important for branches is being a part of the community and being able to be involved with a lot of the things that are happening in the community and having that connection with people in the community. So I think that's also really important.
Over here real quick, and then we'll ask.
That was almost exactly what I was going to say, so thank you, and so well said. The only piece I'd like to add is that's very similar to other industries, parallel that same mindset. So there's some studies that came out in the retail industry along those same lines, showing that when there's a brick and mortar store, even though they may not have the size and the item that you need, you're more likely to shop there, even online, because you're able to go there for the trust factor, see, touch when you need to. So it's very similar in a way to the banking industry, where we are serving our communities, but you have to be there so that when your members, customers need you, you're present.
Matt, did you want to add anything?
No, like Mike said earlier, everything's been well said, but I think one other aspect of brick and mortar, the new branch, as you would say, versus having these 10 or 20 teller windows and this multi-million-dollar office that needed to be built, it actually reduced a lot of the barriers to entry for a bank to open a new branch office somewhere. We can pop an office in a plaza somewhere with an end cap for a drive-through much more quickly, much more efficiently than previously, where we would have had to build these multi-million-dollar buildings anyway. So I'm not sure if that's what you're employing with your plan to double your branch size, but again, you can certainly open an office much more efficiently and quickly than in the past.
Christine talked about retail and how retail is a great example of how they blended the physical and digital, so a phygital kind of strategy. And you see that with Best Buy, Target, Walmart, that had huge physical footprints, but integrated with their online shopping, and where you order your groceries online and go pick them up. I mean, that type of integration between the physical and digital, I think that has been illustrated in the retail space, is what we can learn in banking and do kind of the same thing. I think you add more value to the member that way.
This is the first time we've had a banking roundtable where we've had both bankers and credit unions here. And I understand that, you're in the same business, sort of, but there are different rules. And one of the reasons why we have bankers and credit unions in this roundtable is because we've run out of banks. There's been too many consolidations here in the area. And when we look at how many banks we have, we used to have 8 or 9 of them that would come to our roundtables. Maybe that's wrong, but where are we headed with more consolidations? What's happening? Obviously, we've got a big consolidation coming up. Josh, did you want to tell us what's happening with Premier?
Yes, so Premier was acquired by WesBanco. This will be my 12th, either on either side of the table in my banking career. Sometimes it's necessary. This was a great opportunity for us and a great opportunity for WesBanco. There was almost zero overlap. Very familiar with the WesBanco folks coming from Sky Bank. A lot of them left and went there instead of going to Huntington. So it's a great fit for us. But what it does for us is it it gets us over that $10 billion hurdle with all the regulatory expense that comes to it, and it makes us a stronger bank, but still able to operate in a community. So I think, to your question, is there going to be more consolidation and acquisitions? Absolutely. Absolutely there will be. And if someone tells you that, then that's just it's necessary in certain instances, because we answer to shareholders, and you have to show enough growth. And there are times in the economy, which like we just hit, where things slow down, you have margin compression, and the opportunity it stretches out too many years to get back to where you wanted to be. So you have opportunities come up like we have coming up soon. It's too good to pass up. So I think you're probably going to see more of these moving forward.
Well, by the time this is published, I believe your shareholders meeting will have already occurred.
Correct.
And so how soon are we going to see the signs, the new
The
signs?
signs a different story. So you'll see legal day 1 in January, where we have regulatory approval and we move forward as one institution. You'll see the conversion probably closer to like May. So we'll do a system conversion, which is great because we use the same system, which is very rare in these instances. All of our systems are identical. I don't know who lined that up, but well done. But yeah, so you'll see probably closer to mid-year where all the signs and everything start to switch.
Did you have a question? Okay, please.
I will say that it's our industry overall. Banks and credit unions are both going to be merging over time. That's how we came to be here in this area. We had Ohio Edison, Tri-County, and Youngstown, 3 credit unions that we put together, and that's how Cardinal originally started in this area. So much so, you get a lot of efficiencies as well. We look at mergers more as a partnership so that we could provide to the same community sort of our philosophy of people helping people. And it helps us to provide these branches at, just as Mike was saying, in a much more efficient way. We're getting ready to open a new branch right here on 224, and that merger and partnership has allowed us to be in that position to be able to do that. So it is good in some ways that we can partner and do more, and in some ways, as you said, it's sad to see just sort of a different evolving industry.
I think there's a certain economy of scales that exists within our industry, and there are different costs that we have today that weren't borne by financial institutions in years past. It was alluded to regulatory cost. It takes a great deal of expense and investment on our part just to comply with regulations that exist. We have new technologies, and these don't come free. They are costly, and every time you make access to financial information easier to the consumer, you also make it easier for the bad guy to get to it. So there's an increased cost to security. It used to be you had to protect your door. Now you got to protect the online access from the cyber criminals. So there's a great deal of expense that's incurred by all the financial institutions. And I just think that the economy of scales to run an institution is rising, which is causing consolidations. Smaller institutions can't afford the cost of being in existence, and so they find a merger partner. So it's almost like merge or be merged in some instances.
And I'd like to address this too, if you don't
Please.
mind, because I do agree with Josh that I think consolidation is here and it's always going to be here. And to your point, that is one of the differences between credit unions and banks. We do have shareholders. They do expect growth. Analysts expect growth. And we look at growth not just for the sake of growth, but when you have the opportunity to merge or partner with another institution, it's very important that there's some synergies there, not only in terms of the efficiency, but also the culture. And I think, any merger that's successful, there's always like cultures, and you really can get some real benefit out of that. The other part of mergers, and I speak from experience, is on the fee business side. We think about bank consolidation, but we've been very successful at Farmers in acquiring insurance agencies, third-party administrators, and we're looking at some other opportunities in the fee space to grow our, that line of business. Because as you know, banks and credit unions, that we are a spread business, and with rates the way they had been, it's been very difficult to make the spread between what we're paying on deposits and what we are getting in loans, loan yields. So the fee income has become very, very important for us. And I think when you look at the Premier West Banco, I would bet that the fee income of that organization will be significant again, and it's important for us. So again, consolidation, it's not a bad thing. the thing is maintaining an identity too, where you do maintain that culture that you've been able to grow with and be successful with,
The community always feels that they're losing something
for sure.
Yeah.
in a consolidation.
And it, 717 last November merged with Youngstown City Schools Credit Union. And one of the things that we tried to do with that merger was take what their mission was, right, to support Youngstown, provide financial services to the school districts. And we wanted to use the scale of 717 to amplify their voice. So rather than Youngstown City Schools merging into a larger institution and kind of fading away with its purpose, we wanted to take that in a different direction. And I think that's, so with that, we're expanding our commitment to Youngstown, and that was driven by that merger. And I think that because we don't have shareholders, our mission is simply to help people live better lives financially and support the communities we serve. We're not boxed into shareholder expectations. Our expectations is simply to deliver great value to our members and to our communities. And I think that mergers with credit unions might take a different philosophy. It's not about trying to increase fee revenue. It's not trying about return to the shareholders. We just want to have a real strong positive impact in the community. And I think that's where we can take mergers and actually amplify the voice of the institution that was merging in.
So I agree with what they just said. I want to go back to what Mike said too. For us, it is different as a credit union. We've also had mergers too. We've had other credit unions merge into us. And it's definitely about being able to continue to serve those members in those areas. And a lot of it has to do with the small credit unions and the cost of technology and being able to keep up with all that and the regulations, the burden of the regulations. And so we're happy that, we're able to continue to serve those areas by having the smaller credit unions or the credit unions in areas that can't afford maybe to offer the technology, and they can merge into us, and then we can still serve those areas.
I kind of like to change the subject unless there's, I want to go to, this has been great about mergers, but I think we pretty much covered that. But most of the Fed regulatory proposals affect larger banks in 2025. How are new and proposed regulations going to affect smaller and mid-sized banks and credit unions? What's on the horizon? And how are they different for banks of any size and credit unions? That's a hard one. Yes.
This is where there is a lot of alignment in credit unions and banks on this topic, because regulation is a big deal. So I'll just take one small example that's actually in Congress right now. It's called the Credit Card Act that they're looking at. Anytime you're making regulation, and in this case in a credit card where you may limit what the late fee you can charge overall to any consumer, or you're going to limit the interchange that you earn when you're using credit cards. When those things happen, whether you're a large credit union, large bank, or small, even though there may be exemptions at different sizes, in the end, it's going to affect everyone. Because once it affects the largest banks, which we all know who they are, and they implement some type of cap fee, you're competing directly with that type of institution. So even though you may be exempt, it's still going to affect you and your consumer in the end. And however it all ends up, in the end, some of these regulations are going to ultimately, the consumer is going to pay one way or another. If you limit the credit card fee, that late fee that you can charge a customer, you're going to have to make up that amount somewhere else. So there's going to be a charge by any financial institution somewhere else to make that up. So that's where a small example that affects everyone in the financial industry.
And consumers, right? So the Credit Card Competition Act, it aims to basically reduce the rewards programs that financial institutions offer their customers and their members. And that, I would have to think that with the public, that has got to be the most unpopular piece of legislation working its way through Congress, right? And it's designed to it's designed to help Discover Card, which is located in the home state of the senators sponsoring the legislation. But you know, it's important for financial institutions to be able to have offer safe credit card products and services, debit card transactions. There's a lot of expense to the financial institutions that offer those programs. And part of what we try to do with that is to reward customers with kind of loyalty programs and all, you know, so regulation puts a lot of that at risk. And I think that's something that the public should be aware of. And it's something that banks and credit unions agree on, is that that's a really bad idea moving through Congress right now.
And then it goes to another level. So when these things occur, which people probably also don't know, the CFPB, who was originally founded to protect consumers, they will do things now charged with what is the ultimate amount to charge. And then they'll do a study, and then the CFPB will come out with, right now they're saying their latest study shows that $8 would be the fee for that their studies show. So it just gets more complicated, and I don't think that the consumer ultimately, if you knew how it was working, you would probably be a lot more proactive.
And it's actually, and I agree, it's like, so I did read up on the CFPB and how they came up with that $8, and it was very arbitrary. And that's what's amazing, is that there's so much cost that goes into offering credit cards and all of the reward programs and all those things that people expect out of it. And so I've actually heard people saying, well, if it's only going to be $8 now, then it doesn't matter if I pay my credit card payment on time. And so it's actually going to have a negative effect, I believe, when you set an arbitrary number like that and you're not thinking about all the costs that actually go into offering something like that and to offering a credit card and network fees and everything that goes into that we're paying for.
Well, now we have a new administration coming in, and we probably haven't seen disruption to the extent we're about to see it in any number of areas. So what's going to happen?
I was going to take a more general approach to this. I received an email from the OBL, the Ohio Bankers League, and they were talking specifically about the congressman who's in the running to become the chair of the House Financial Services Committee. He's from Arkansas. He was elected in 2016, so the first Trump administration. He was also a community banker, and his motto, if you can believe it or not, is make community banking great again.
No.
But again, when you read the proposals of this gentleman, his name is French Hill, it's all about regulatory easing. It's all about making it easier to, streamlining exams, making it easier to go through the merger process. He's got 8 or 9 bullet points that he talks generally, and I think this is going to be the kind of the pervasive view in Congress is to ease some of these burdens on banks. And we are a national bank, so we're regulated by the OCC and the Federal Reserve, and we expect that there will be some of this easing that will make it, better to do business, more efficient. Some of the things that we're talking about specifically will probably find themselves on the back shelf somewhere. And I'm very confident this new administration will be, pro community banking, pro banks, pro financial services.
So we saw this in 2016, where you reduced regulation, and it took probably the majority of the year to catch up. The idea goes into place, and then the examiners and everybody else, they kind of have to catch up and get everything in line. So probably towards the end of 25, you'll see a lot less regulation that we can go by, and I think that's good for the consumer because, banks don't want to spend their money on keeping up with regulation, and with, like you said, streamlining things are great for us. That means we can turn around and we can give that money back to products and services. So we're looking forward to that. We think that's a good thing. And like you said, especially keeping up with technology, there's a big expense that comes with that. So knowing that we can reroute those funds to a different direction towards the consumer is a good thing.
Earlier in our conversation, we talked about technology, and that's certainly going to invite additional regulation. There's going to be bad actors, bad players in that community that are going to have to be dealt with. And sometimes you get well-intentioned regulations that have negative consequences that have to be addressed after the fact. That's all costly to have to deal with from our chairs. But I think that the technology alone is going to invite new regulations that each of us are going to have to employ into our operations.
Well, let's talk about what's on the horizon. There's threats of big tariffs. We don't know if that'll happen, but there's threats of big tariffs. And everybody wants to know what's going to happen regarding interest rates. What's your forecast for mortgage rates? How do you think that's going to affect the local market? I'm throwing a bunch of stuff out here. And also, if inflation continues to stay around 2% and the Fed drops interest rates, how's that going to affect bank lending? So what's the crystal ball looking like?
If someone knows this, I'm impressed.
What's that?
I said, if someone knows this directly, I'm impressed.
Yeah.
So I'll speak first if you guys don't mind. Initially everybody thought rates were just going to plummet and rates were going to go back to around the 5% quickly. That has slowed down drastically just because inflation hasn't dropped to where I think we need it to. I do think rates will continue to tick down.
You're talking about mortgage rate?
Mortgage rates, I think treasuries, I think you're going to see that tick down. And I think as rates come down, so banks, credit unions are sitting on long-term mortgage rates, probably an average of, I'll guess at 4%. So you need rates to almost get into the fives for people to say it's worth moving. Because you're sitting on all these low interest mortgage rates and it's hard to move from your home when you're at a 3, 2, 4% rate and you're looking at 7. So for mortgages to move, I think you need to get into that 1% range where you say, okay, it's worth my time. But you said to the inflation at 2%. I don't think lending has slowed down drastically. I think what happens is people that are on the fence, they wait to see if that's going to happen. And I think once it comes down to a more manageable number, I think you'll see businesses going out and lending much more.
It's interesting if you look at the rates earlier in the year, about April to August or so, we started to see mortgage rates fall. And about 8 weeks ago, we see the Fed lower the interest rates by 50 basis points, and then they followed up with another 25 basis points, and they're promising perhaps another 25 basis points in December. During that period of time where the Fed dropped the rate 75 basis points, mortgage rates actually went up about 75 basis points. So there's a lot of uncertainty that exists in 2024. If you look at what the target rate was for 2025, it was 3%. The Fed now has raised that up 100 basis points to 4%. So there's just so much uncertainty that exists in the market that it's hard to have that crystal ball to say what's going to happen. Certainly inflation being lowered is going to help create some stability in home prices. I think that the inventory of homes are going to also increase or has increased a bit. That's also going to help buyers of property. The interest rate is just one component of the overall cost of ownership. And so I think when you add those other items in, you're likely to see a better 2025 than you saw in 2024.
I think you also have to consider when you're talking about the mortgage rates, there was another economic analysis that we just looked at. Home prices also have to come down for the optimal period for mortgages and homes to take off would be home prices have to come down about 10%, and about the same time that they have to come down 10%, the rates have to come down around 1.5 to be in that 5-point range, and income has to be about stable. Those are the optimal conditions that economists are now predicting that will then help spur the market. So it's interest rates plus the other components. FHA just had an article in the Wall Street Journal about mortgages. They've increased about 7%, which is ironic that they've been able to increase 7%. And then the last study that came out just in October showed that there's a 2% increase in applications for the mortgage market. So you are seeing little upticks in an improvement as those rates have come down slightly with the fluctuation in the high rate, low rate. But there are also some more optimal conditions to help really get the market back to a better point.
On the business arena, anyway, as far as business lending goes, many of my clients, they were excited about, frankly, the election, the downturn in rates so far, that a lot of them had put projects on hold, waiting to see what administration would be in power. A lot of the Trump era tax cuts from 16 were set to expire, have been winding down, and then that would cause a lot of people to wait and see. So at least the forecast from many of my clients next year, projects are back back on the front burner again that maybe had been shelved this year to wait and see, both for interest rates as well as some potential tax breaks as well. So I anticipate a good year in 25 for business lending anyway from what we've seen so far.
But what about tariffs? What if he does do what he says he's going to do on day one? I mean, I know there was a threat yesterday against Canada. I mean, I understand it's a negotiating tactic, but what about tariffs?
Yeah, I think, at the end of the day, tariffs act very much like a value-added tax, which would increase the cost of goods and services that consumers purchase. And so, in effect, it's elevating inflation across the economy, and that necessitates rates staying higher to keep inflation down. So, some of the language might be negotiating tactics, but in general, tariffs would increase the cost of goods and services that we all pay, acting as effectively a massive sales tax. So that's one of the risks with moving forward with an aggressive tariffs program. Now, there's value to protecting certain core industries, such as manufacturing, but it comes at the risk of heightened inflation. Back, on housing, Christine, really highlighted some good points here, that it's not just about the interest rates, it's about the actual cost of the homes themselves. And I think the challenge for folks in the Valley is that housing is so, even where the Valley is low cost relative to the state and to the nation, it's still very unaffordable, unattainable. And there has to be a movement towards lowering the cost of housing and providing financing solutions that can lower the overall payment. It all comes down to monthly payment of what people can afford. And I think that's what we have as collective financial institutions. We have to come up with a solution for it.
How are you going to get people to lower how much they want for their houses?
Well, I think you can do it in a way that is twofold. So think about one of the things for increasing the housing supply is one step of providing affordable housing. But the challenge with that is as you bring in stick-built homes, if you will, like construction on-site housing, we are competing with the labor to build those homes with markets like Columbus, Ohio, where those workers can sell that home for 3 times as much as here in the Valley. And so it becomes a supply and demand of labor expense that makes it really unaffordable to build houses here. So I think a different solution is with modular homes, bringing modular homes in. They look fantastic. You can do a 2-story garage, basement, but it's a fraction of the cost, and the manufacturing is not necessarily done on site. That's a way that we can lower the cost of housing in the Valley with new construction and expand the housing supply. I think that might be something to look at.
And I would like to give credit to Eastgate and the Chamber. I know they've taken this challenge on. They've done some surveying. They're trying to figure out how to come up with more diverse housing. And I think we're going to see the fruits of that report in January, which is really going to outline a plan for the Valley in terms of how do we tackle this problem, because it is unaffordable. Inventory is extremely low. And again, I give credit to the Chamber and Eastgate for, taking this issue head on.
Anyone else?
I just wanted to kind of say that you're seeing what John just said, and Christine and everybody. It's really unpredictable as far as trying to say what's going to happen next year. And with all of, if the tariffs go through, you're absolutely right, John. That could drive prices up. Actually, it could cause us, inflation to go. So it just depends on what's going to happen next year. I don't think anybody here has a crystal ball, so it could go either way. And if that happens, if all of the, if it's true about the tariffs and all that, the cost of goods will go up, and then inflation will go up, and then interest rates are going to stay where they are. They might go down a little bit at the beginning of the year, but then as things start to happen, interest rates could stay where they are and they could not, we won't see that 5%. They're gonna stay elevated.
We're going to conclude by asking everybody for some final thoughts of what we haven't mentioned that you think we should have mentioned, anything in your industry that you think we should talk about. Just some final thoughts, and you can keep it brief. We'll start with Mark.
Oh, yeah, I think we're very fortunate here in the Valley that even though we've lost financial institutions, I think you can see right here that we have a very vibrant financial services sector served by both banks, credit unions, and other financial service professionals. So I think the consumer in the Valley has a lot of options, a lot of choices. Obviously, they can do some other things, as we discussed earlier, online. Again, so I think we're very fortunate in that regard. I think the commitment of all these financial services professionals are also very evident, very up to date with what's going on, very focused on the customer, very concerned about the macroeconomy and what the impact is, and then very focused on, making our communities better, making sure that people have affordable housing, making sure that those that are in need do get what they need from all these excellent bankers and credit union professionals. So again, I feel very comfortable in knowing that and learning that today better than I did before.
Josh?
Yeah, I think it's all about culture. I don't really think it's about the name on the sign. I think it's about the culture within each bank or credit union. What each employee believes and why they show up every day. And like Mark said, it really is about making our community stronger. Because if our community weakens and our community goes downhill, where does that put the institution that sits in that community? So we talk about that constantly. We talk about, getting out, being a part of it. I know it was said earlier by John that it's important to have branches because you're a part of that community. And that really is, it's what it's about. Having a local voice, making sure that someone in a city that's never been to Youngstown is not making decisions in Youngstown. It's about someone that's sitting here. And I think that's very important moving forward. And I think we're lucky to have the people sitting around this table for those voices.
I agree. I was just thinking about the one thing that was touched on a little bit is financial education. It's really important that all of us work together and collaborate, the banks and the credit unions working together and making sure that we're out there in the community helping people, but also providing the financial education that they need, letting them know here's what's available and here's how you can make your life better. So we're focusing a lot on financial education. We just built a new building which has a financial training room, and we're offering all different types of seminars on fraud and on first-time home buying and all those things so that we can focus on making sure that the community is empowered with knowing how to take care of their finances. And I'm very impressed with everybody that's here today. So thank you for inviting us.
Thank you.
Yeah, I want to echo what everyone said, but, Mark made the observation. I've been in banking for 30 years, and I've never sat in a room with folks that are as dedicated to the community as the folks that are in this room. Farmers, local bank, Premier does incredible things for the community. Middlefield is a great community bank. The credit unions in the room. The community needs to know that the financial institutions in the Valley that are here, the ones that have survived all of the mergers, and these are some dedicated people to improving the lives of the community here, and I'm really just honored to be a part of the group.
Yeah, well said, John. Looking around this room, think of all of us that are headquartered here in Northeast Ohio. And not all communities can say that they have such a diverse group of banks and credit unions where local decisions are made, where banks are partners with the community. So this is exciting. It's good for the consumer in our market. I think the biggest challenge going forward is just balancing the need for innovation and then the compliance costs. And back to the previous discussion, you will see more mergers, you will see more acquisitions, just to frankly balance that new expense that a lot of banks are going to have to endure when it comes to new regulations that may come across us. But again, the group here, looking again, this is a solid group and from Northeast Ohio, which I like to see.
I will just add, I mean, roundtables like this just are very energizing, refreshing to be able to share ideas with the common goal is the same. We're all here to serve the community. And so just happy to do that and happy that you had us here today and happy that we're able to be a part of it and to see what happens. You know, we're very excited about opening a new branch to see what that looks like here. And so thank you.
Okay, Mike.
Well, one of the things I don't think that we talked about too much is the demographics of our community. One of the challenges that we have that I identify with anyways is that we have an aging community. And with that, I think that one of the challenges that's going to exist for all financial institutions is competition for the new dollars, for the new individuals who are going to be our future. And what we as institutions are going to be able to do within our own shops to be attractive, to be pertinent, to be relevant to their needs so that we all survive. Because I think one of the things that happens when we as local institutions remain relevant, we keep our community relevant. If we are all victims of mergers to institutions outside of the area, the Mahoning Valley will suffer as a result of that. We will lose relevancy.
Well, thank you all for coming. This has been a fabulous discussion. Thank you for giving us some of your time and your expertise, and thanks.